And Jenny, we're talking the auto parts companies. The two in particular today that we're looking at are AutoZone and O'Reilly. And so we're hearing about demand for cars potentially going down, right? That's why Tesla's allegedly cutting their prices. Yet it seems that the market, or at least the analysts today, not Oppenheimer in particular, not a super fan of either one of these auto parts companies. So there's no demand for parts or cars, I guess.
I guess so, and I thought the narrative was that with cars getting more expensive, people are just fixing up their cars themselves. I have honestly never been to an O'Reilly or an Advanced Auto Parts, but I can respect the DIY business. I perhaps wouldn't be doing that on my own car, but I can respect it given the fact that I don't even have a vehicle. But here to tell us now more on a lot of this downgrade, but not any selling today in both these names, I'd like to welcome in Jeff Pierce, the Senior Manager of Derivatives Trading for Charles Schwab. So Jeff, walk us through this downgrade we're seeing today.
Yeah, we've got Oppenheimer downgrading two of the big auto names here, AutoZone and O'Reilly. They moved them both to perform from outperform. On the price target for AutoZone, they moved them to $2,600 down from $2,850. For O'Reilly, they moved their price target to $930 down from $1,000. Now, the analyst says the pandemic-related tailwinds for the group are likely to continue to fade, thereby undermining prospects for sales and earnings upside at the chains and outside money flows in the shares. The firm also says that while the street's current forecasts appear largely reasonable, it's now more hard-pressed to envision multiples shares climbing meaningfully from their current levels. And I think if we look at these names, a lot of what you just brought up, I mean, these auto parts retailers really did well at the start of the pandemic. We had those high, a lot of demand for new cars, not a lot of new cars out there. Prices were certainly getting high on both the new and the used market. Plus, inflation was really surrounding consumers everywhere they turned, so they were mainly fixing their cars rather than buying new ones. Since then, we've seen this big travel boom, right? And we've seen pretty decent weather as well, which pushes more miles driven and usually helps these companies as well. Having said that, this year, these auto part retailers have generally lagged the general broader market. A lot of that has to do with some of the tough comparisons they have against 2022 and 2021.
You know, Jeff, I would have thought that O'Reilly song alone would have been enough to keep this thing in the outperform camp. What else are you focused on with either this industry or one of these names in particular that the viewers should know?
Yeah, I mean, the names need to continue to work well on the domestic front. That's something we've seen investors, concerned about, especially around AutoZone. They saw domestic commercial sales up just 3.9%, coming in at just under $1.5 billion. That came in below estimates. Total same-store sales grew 4.5%. That beat analyst 2.4% estimate, but that's down from 7.1% last year. Similar story out of O'Reilly. Numbers have looked really good. This has actually been the winner of the group, up 23% over the last 12 months, up 7% year to date. Continuing to make sure that they are forecasting what they need in terms of parts is definitely a big part of it. Car supply has started to rise a little bit. We're seeing prices come down. That certainly could put some pressure on there. But as you pointed out, demand has largely come down as well. And if inflation is no longer putting as much pressure on some of the consumers out there, we may see them kind of push away from just fixing their vehicles.
And Jeff, what I have to add that's sort of amazing to me is the divergence in performance. We have AutoZone, O'Reilly, both positive for the year. And now we still have Advanced Auto Parts down 64% this year and still lower today. I mean, this space is like not trading in tandem at all anymore.
Yeah, absolutely. Advanced Auto Parts has really been kind of the different one of the bunch. If you look at a 5-year chart for all three, you see O'Reilly and AutoZone just climbing, where Advanced Auto Parts really starts to fall around the beginning of 2022. A big drop in May after they missed on earnings and lowered their guidance. They've also, on top of cutting their full-year profit outlook and earnings per share, they've had their ratings lowered by in a junk territory by S&P Global Ratings earlier this year. The numbers continue to not impress investors, and a big part of it is them trying to improve their ordering, right? We continue to see them try to get rid of the products they have on shelves already, and that's been a struggle for Advanced Auto Parts in a way that we haven't seen for O'Reilly and for AutoZone.
Yeah, that divergence performance has been fascinating to watch. It's been pretty persistent all year long, but we'll leave it there. Great breakdown. Jeff Pierce, Senior Manager of Derivatives Trading for Charles Schwab.